Every set of financial statements is the output of a structured process, the accounting cycle. Most practitioners know the individual steps, but understanding why they are sequenced the way they are and what each step is actually controlling for makes you a sharper reviewer and a better preparer. In this episode, we walk the full cycle with precision, flag the IFRS touchpoints, and ground it in a realistic worked example. The cycle has 8 distinct stages. Identify and analyze the transaction, record it in the journal, post to the general ledger, extract an unadjusted trial balance, process adjusting entries, produce an adjusted trial balance, prepare the financial statements, then close temporary accounts and start again. Each stage has a specific control purpose. Skipping one does not just create extra work later, it creates risk. Stage 1 is transaction identification. Under the Conceptual Framework, an event is recognized only when it meets the definition of an asset, liability, income, or expense, and the recognition criteria that it is probable the economic benefit will flow and the amount can be measured reliably. This is not automatic. A signed purchase order, for example, is not yet a transaction for accounting purposes. Delivery and the transfer of risks and rewards matter. IAS 1 requires faithful representation, so identifying the correct economic substance of the event is the foundation everything else rests on. Stage 2 is journalising, recording the entry in the general journal with date, accounts, amounts, and a narrative. Stage 3 is posting, transferring those debits and credits to the individual general ledger accounts. The ledger is your source of truth for balances. A common error here is posting to the correct account type, but the wrong sub-account. For instance, posting a lease liability repayment to bank loan, rather than to the IFRS 16 lease liability. That error will not surface until you reconcile the ledger to the underlying schedule. Stage 4 is the unadjusted trial balance. You extract every ledger balance and confirm that total debits equal total credits. This catches arithmetic and posting errors, but it does not catch everything. A debit posted to the wrong expense account will still balance. So the trial balance is a necessary but not sufficient control. Its real value is that it gives you a clean starting point for adjustments. Stage 5 is adjusting entries, the most intellectually demanding part of the cycle. There are 4 categories: accrued revenues, income earned but not yet invoiced; accrued expenses, costs incurred but not yet paid; deferred revenues, cash received before performance, creating a liability under IFRS 15; and prepayments, cash paid before the expense period, sitting as an asset. On top of these, you have non-cash adjustments, depreciation and amortization under IAS 16 and IAS 38, impairment testing under IAS 36, and fair value movements under IFRS 9. Every one of these must be processed before the trial balance can support a set of statements. Let us ground this in a worked example. It is the 31st of March, the period end. Your unadjusted trial balance shows 3 items requiring adjustment: rent prepaid of 90,000, 2 months paid in advance, so 1 month, 45,000, is now an expense; an accrued audit fee of 30,000 not yet invoiced; and straight-line depreciation on equipment of 12,500 for the month. Here are the 3 adjusting journal entries. After posting those adjustments, you extract the adjusted trial balance. The net effect on profit before tax in our example is a reduction of 87,500, 45,000 rent, 30,000 audit fee, 12,500 depreciation. The adjusted trial balance is the direct input to the income statement, statement of financial position, and statement of changes in equity. IAS 1 requires at minimum 2 periods of comparatives, which means your adjusted balances must be consistent with how the prior period was closed. Stage 7 is financial statement preparation. The adjusted trial balance feeds directly into the primary statements. Revenue and expense accounts flow into the income statement. Asset, liability, and equity balances populate the statement of financial position. The profit or loss for the period bridges into the statement of changes in equity, and the cash flow statement is prepared separately, either directly from cash receipts and payments or indirectly by reconciling profit to operating cash flows under IAS 7. Stage 8 is closing the books. Temporary accounts, all revenue, expense, and dividend accounts are zeroed out and their net balance is transferred to retained earnings. This resets the income statement for the next period. Permanent accounts, assets, liabilities, equity carry their balances forward. The post-closing trial balance confirms only permanent accounts remain open. A common error is failing to close a suspense or clearing account at year-end, which pollutes the opening balance of the next period and creates reconciliation pain months later. A practical point on the cycle's frequency. The 8 stages apply whether you are closing monthly, quarterly, or annually. In a monthly close, not every adjustment will be material enough to process, but that is a professional judgment call, not a license to skip steps. Under IAS 34, interim financial statements must apply the same recognition and measurement policies as the annual statements. So the cycle for an interim period is not a lighter version. It is the same rigor applied to a shorter window. One area that separates strong preparers from average ones is cutoff. Transactions near the period end must be captured in the correct period under the accrual basis required by IAS 1 paragraph 27. A December invoice dated the 2nd of January. For December services is a December expense. A shipment that left the warehouse on the 30th but was not invoiced until January still needs a revenue accrual if control has transferred under IFRS 15. Cut-off errors are among the most common audit findings precisely because they require judgment, not just data entry. To summarize the accounting cycle, it is a disciplined sequence, not an administrative formality. Each stage has a specific control purpose. The adjusting entry stage is where IFRS standards most directly interact with the bookkeeping process. Closing entries are what make the income statement a period statement rather than a cumulative one. And cut-off discipline is the practical expression of the accrual principle. Get these right, and your financial statements have integrity from the ground up.